It can feel pretty overwhelming trying to figure out which way the market's heading, especially when you're hunting for those growth stocks, the ones that might really take off.
Oh, absolutely. It's like a sea of noise out there.
Right, like trying to pick out one clear signal from just static. But what if you could actually see, like right there on the chart, almost a footprint of the big institutional guys making their moves?
Ah, yes. That's the really fascinating area we're digging into today. You're talking about those specific shapes, those patterns on a stock chart that, well, they suggest pretty significant activity by the big money.
Exactly. Big money footprint.
And those patterns can be, incredibly useful for getting a handle on where the price might go next.
Yeah. And that leads us like straight to the focus of this deep dive. The flat base pattern. Our sources, they describe it as really reliable and maybe more importantly, pretty straightforward to spot, especially when the market itself is generally moving up, in a bull market. It feels like something anyone interested in catching those big breakout trades really ought to know about.
Definitely. And for you, the listener, this is all about getting a practical grip on a specific strategy, one that can help you pinpoint potential, let's say, high probability growth opportunities.
Without getting totally bogged down in a super complex analysis, right?
Exactly. Think of it as a way to get well-informed about this particular chart pattern and sort of the story it might be telling.
Okay, so our mission today, pretty simple, pretty direct. We're going to unpack this flat base pattern. We'll define what it is, show you how to actually see it on a stock chart.
Visually, yeah.
And explain the reasons, the why behind its effectiveness, why it might foreshadow those potentially, explosive moves upwards. We're really going to focus on the practical side, how to recognize the key characteristics yourself.
Sounds good.
Okay, let's dive right in then. What exactly is a flat base? Give us the definition.
Okay, so in essence, a flat base is just a period where the price consolidates, it moves sideways in a tight, shallow way, and this happens after a stock has already been in a clear uptrend.
After it's already been climbing.
Right. An uptrend, just for clarity, means the stock price has generally been moving higher for a bit. So picture a stock, it's climbing, and then it pauses.
Takes a breather.
Exactly. It stops going up much, but crucially, it doesn't really fall back much either. That sideways bit, that's the consolidation, that's the base.
Okay, so it's like the stock is catching its breath after a run. What are the specific things, the numbers, the behaviors we should look for on a chart to say, that looks like a flat base?
Good question. There are several key characteristics. Numbers are important here. First, the pullback. That's the little dip from the high point just before the sideways move down to the lowest point within that base.
Okay.
That pullback is typically quite shallow, generally no more than 10%. That's a key number, 10%.
Only 10% dip maximum. Got it.
Second, the duration. This sideways period, it needs to last a decent amount of time. Our sources point to at least 5 to 6 weeks. Sometimes longer, but that's the minimum.
5 to 6 weeks. So over a month of the price just hanging out in a narrow zone.
Precisely. And the price action during that time, it should be relatively quiet, contained. You don't want to see wild, erratic swings up and down or big, scary sell-offs within that base. Tightness is key.
Right, calm and tight.
And finally, this is super important for figuring out when you might actually trade at the buy point, often called the pivot point.
The pivot, yeah.
That's usually identified as the highest price on the left side of the base, basically the price level where that initial small pullback started from.
Okay, so quick recap. Small dip, maybe 10% max, then sideways, fairly calm for 5-6 weeks or more. And we're watching that starting point of the dip as the level to potentially buy if it breaks above it later.
You nailed it. That's the core structure.
So how does this compare to other patterns? We hear about cup with handles, double bottoms. Is this simpler? Different implications?
That's a really good point. Compared to something like a cup with handle, which usually has a deeper, more rounded sort of correction.
Right. Looks like a teacup.
Exactly. Or a double bottom, which obviously involves two distinct dips and rebounds. The flat base is much simpler visually, and it's shallower. That minimal dip, that 10% or less, that's the big differentiator.
And what does that shallow dip tell us?
Well, it strongly suggests underlying strength in the stock. It hints that institutional investors, the big funds, are likely providing support there. They're stepping in, preventing a bigger sell-off.
Institutional support. That sounds like a really positive sign. So let's dig into that more. The why. Why might these flat bases actually, predict anything? What's happening under the surface?
Yeah, the underlying mechanics are pretty interesting. It's essentially what you said earlier. The stock is pausing resting near its recent highs, like a rest stop on an uphill climb. During this pause, the so-called smart money, the big institutions, mutual funds, pension funds, hedge funds, they're often quietly accumulating more shares, buying little by little.
Without causing a big price spike themselves.
Exactly. They're trying not to show their hand too much. This quiet buying, this accumulation, it's not just, academic. It can reveal a potential imbalance brewing, more demand than supply, building up quietly. Gives sharp observers an early clue.
So they're kind of building a launch pad, adding shares strategically before the next potential leg up.
That's a great analogy, a launch pad. And this whole pattern, this flat base, it sends some important signals. First, it suggests the stock is fundamentally strong, right? And it's probably under pretty tight control by these big players.
Fewer shares floating around for sale.
Precisely. Second, that shallow pullback we keep mentioning, it shouts. Lack of significant selling pressure. People aren't rushing for the exits. Very good sign. And finally, it implies there's this group of buyers, likely those same institutions, just waiting, poised, ready to push the price higher once it clears that consolidation range, that pivot point.
Okay, that paints a clear picture. Low selling interest, big buyers potentially accumulating and ready to go. So, for the listener, what's the real payoff here? Why bother learning to spot this pattern?
Well, the direct benefit for you could be potentially an increased probability of finding a successful trade, getting in before a significant move. And, importantly, because the base is shallow.
The 10% thing.
Right. That allows for more effective risk management. You can usually set a tighter stop-loss order just below the base.
Meaning you risk less if you're wrong.
Exactly. It helps limit your potential losses if the breakout fizzles out, which sometimes happens. The real insight, maybe, is shifting your mindset, moving from just reacting to news to actually recognizing these deliberate, almost hidden actions by the major market movers.
Seeing the footprints. Okay, so we get what it is, why it might matter. Now, the practical bit. How do we actually spot one on a chart, day to day? What are the specific visual cues?
Right. You'll want to look at both daily and weekly charts, get both perspectives. Our sources give a really helpful what to look for checklist. It's pretty concrete.
Okay, checklist time. Lay it on us.
First, you absolutely need that prior uptrend. The stock has to be moving up before the base forms. That's non-negotiable.
Check. Uptrend first.
Then you're looking for that pullback we talked about. No more than, say, 10% generally. Sometimes a tiny bit more, but shallow is the rule.
Okay, shallow pullback. Check.
After that dip, you need that sideways price action, that consolidation, and it needs to last for at least 5 weeks, minimum.
5 weeks sideways. Check.
Now, here's another key visual. Volume. The trading volume, the number of shares traded each day or week.
Yeah.
It should ideally decrease, sort of dry up as the base develops.
Volume goes down during the sideways part. Why is that important?
It suggests selling interest is fading. Fewer people are willing to sell at those prices. It reinforces that idea of tight control and lack of selling pressure.
Ah, makes sense. Less supply. Check. Volume dries up.
And finally, you need to clearly spot that pivot point. Remember, usually the highest price on the left side of the base where the pullback started, that's the level the stock needs to convincingly break above.
The breakout level. Check. Clear pivot. Okay, that's pretty clear. Uptrend, small dip, sideways for 5+ weeks. Volume fades, then watch the pivot.
That's the ideal picture. Now, just as important is knowing what to avoid. What are the red flags?
Good point. What makes a flat base maybe not so flat or not so reliable?
Our sources have a what to avoid list too. Be wary of bases that are much deeper than, say, 12–15%. If it dips that much, it might signal some underlying weakness, not the same strength.
Okay, too deep is bad.
Also, avoid bases that look really choppy or wide. Lots of erratic price swings back and forth within the base. A true flat base should look relatively tight, orderly, contained.
Not messy. Got it.
And, this is important, we'll talk more about it, but be a bit more cautious with flat bases that form very late in a really long extended uptrend. They can sometimes be exhaustion patterns.
Okay. So just because it looks like a flat base doesn't guarantee it's a good flat base. That brings us nicely to this idea of early versus late stage bases. Why does it matter when in the overall trend these things show up?
Timing is, well, it's hugely important in trading, isn't it? Think about the stock's whole journey. Early stage bases, they tend to form relatively soon after a brand new uptrend gets going.
Like after a market correction ends or a bear market bottom.
Exactly, those times. These early stage bases often pack the most punch, the biggest potential for significant gains. Why? because they're capitalizing on that fresh initial burst of enthusiasm and, crucially, renewed institutional buying as the stock starts a whole new upward phase.
So you're getting into relatively near the beginning of a potential major run, more runway ahead.
That's the idea. More potential runway. Now, contrast that with later stage bases. These show up after a stock has already had multiple strong runs higher. It's been climbing for a long time.
Okay.
Now, these later ones can still work. They can lead to further gains sometimes, but they definitely carry a higher risk of failure.
Why is that?
Because they often attract what traders call late buyers. People jumping on the bandwagon after most of the easy money, the big move, has already happened. This can lead to, well, exhaustion. The buying power just isn't there anymore.
Right. The trend might be getting tired. Makes sense. The initial big push is done.
Precisely. Less fuel left in the tank, potentially. And one more critical point here, which our sources really stress, always consider the overall market context.
The general market trend.
Yes. Even the most picture-perfect flat base on a stock chart could just fall apart if the broader market suddenly turns weak or rolls over into a correction. The market tide lifts or sinks most boats.
So context is king. Okay, theory's good, checklists